Hey everyone, welcome back to Policy Punchline. Here at the show, we interview scholars, policymakers, and business executives about some of the most urgent issues and frontier ideas in our world today. I'm Princeton senior Tiger Gao. Today, joining me is JC de Swaan. He is a lecturer in the economics department at Princeton and a partner at Cornwall Capital, a New York-based investment fund. At Princeton, he teaches classes in financial ethics as well as Asian capital markets, and he recently published this great book titled Seeking Virtue in Finance, Contributing to a Society in a Conflicted Industry, in which he suggests a framework for acting virtuously in finance and shining a light on inspiring individuals in the industry. He challenges traditional concepts of success in the industry, making his work applicable to everyone in and outside the world of finance. So thank you so much for joining me today, Professor de Swaan.
Great, and thanks so much for having me here today. I'm really excited to have this conversation.
And co-hosting the show with me is my partner at Policy Punchline. She is our new president of the show. If you're wondering why Policy Punchline has been able to keep up with our update pace and been able to produce at such a ferocious pace, it is because of her effective management of the team, Roopa Venkatraman. She is a junior in the politics department. So thanks so much for being here with me, Roopa.
Of course, Tiger, my pleasure. Thanks for having me.
So Professor de Swaan, why don't we jump right in? I thought I would start with a very broad introductory question to who you are and also how it came about for you to write this book and your journey writing this book. So would you mind telling us a little bit about that?
Sure. So this book is really derived from a course I've been teaching at Princeton for the last 10 years on ethics and finance. Provocatively, it's taught as a freshman seminar, and just I should mention as Tiger mentioned, for context, I divide my time between teaching and working in the investment world. But my angle into the investment world, I think, it may have been a bit atypical in the sense that I studied public policy and economic development in graduate school. And I entered the industry with a view or with a particular interest in understanding how finance could be a tool to help develop prosperity, to help economic development. And my entry point into the industry was actually to invest in emerging markets, and specifically in Asia. So I'd always had this interest looking at finance as a force for good in society. And what I found as I began teaching, so I started teaching about 12 years ago, I found that a lot of my students are interested in going into finance, but they're very concerned about being corrupted the minute they walk into their first job on Wall Street. And so I created this course on ethics and finance. And what was interesting to me is the first time I taught this course, halfway through the semester, one of the students came to me and she said, why is it that we're so obsessively focused on unethical behavior? Why not talk about inspiring behavior? Why not talk about thoughtful people? And I thought, of course, why is it that we never talk about that and that we never really read about this? And so I went out to look for literature for the course on this. I couldn't really find any. And so I ended up writing this book. And the idea was to identify remarkable individuals in the industry, but also individuals we could relate to. So they're not altruistic necessarily. They're self-interested. They're ambitious. Many of them are successful, each in their own way. But what I was looking for were individuals that were able to balance their self-interest with the collective interest, despite the enormous pressure that they often feel because of industry norms and because of the incentives in the industry to conform to what is often a focus on short-term profit maximization. And so I went about to find these individuals, and I ended up, I think, writing about like 60 individuals and firms. And there's a lot that I think we can learn from now. Now, to be clear, and I want to make sure like to mention this up front, is the underlying premise here and my fundamental belief is that finance is a force for good, right? And it's a force for good in society because one, it clearly fulfills a fundamental function in our economy, but it's also, there's also some research that shows that it has all sorts of positive indirect consequences on society, in that it boosts economic growth up to a certain level. It facilitates entrepreneurship. It's helpful to corporate governance. It also boosts innovation. So there are all sorts of things that are positive about finance. But at the same time, it's hard not to observe the industry and come to the conclusion that, the industry over the last few decades seems to have swayed away from its client-serving mission and from its singular focus on supporting the real economy. And so, and I should mention, it's not all of finance, right? I want to be clear about this. I think, in fact, it may be that the majority of finance is on the right side of the ledger there. But there's a large part of finance where that's been growing and where there's a question mark as to its role in society. So to kind of finish this like broad, like a quick overview, what I try to do is find these individuals and then tease out a framework, essentially, like tease out a sense for if you were a well-intentioned person that wanted to go into the industry and wanted to be thoughtful about your impact on others, what would be the markers of virtuous behavior? What would a virtuous career look like? And that's led to a framework. So in a nutshell, that's what I try to do.
I think we would actually love to hear a little more about this framework. So you propose a sort of four-pillared way to assess the way in which finance professionals affect each other, and you reduce this to 4 tenets: serve your customers faithfully, do not extract value from others, treat colleagues with dignity, and as much as possible, apply your finance skills and resources towards the collective interest. Can you give us a sort of high-level overview of these 4 tenets?
Sure. So the first one, serve your customers' interests with their interest in mind, even when no one's looking. And the point is that in the industry, often it's the case that no one is looking because so much of the interaction between financial firms and their customers are regulated by the fine print, right? And so very often it's hard to know like these dynamics. And the point is that there's no virtue in a sense that is more important than serving your customers faithfully, because that's your professional mandate, right? And so that's the first point, and there's no way around this. It's you're in the business of serving customers, you're an intermediary, so that should be your foremost goal. Now, the second pillar reflects a conundrum, and that's the part that I feel the industry may not have devoted as much attention to as it could, which is, and the conundrum is that it's plausible, or it's possible for you as a finance professional, as a financial firm, to serve your customers very well, or to do so by extracting value from the rest of society. And you often do it in a way that's unwitting. You're not necessarily aware of it. And it's just because by serving your customers well, you're fulfilling your professional mandate, and it's good for your customer and it's good for you. But there are all sorts of situations where the way in which you create value for your customer is to extract value from other stakeholders. And that's the part where I think as an industry, we can be more thoughtful. The third pillar is, so in the hierarchy, I would argue that it's less important than the first two, but it's still critical. Now you look within the organization, and it's really the extent to which you treat your colleagues, your employees with dignity, you help develop them, and you empower them, and importantly, you promote diversity, and you ensure that you don't discriminate. So that's within the organization, and that's often not something that you would explicitly think of in terms of your impact on society, because it's a smaller constituency that you're addressing here, but it's an important point, I think. And then finally, what I found from researching these role models is the extent to which many of them end up using their skill set and in ways that so they use their skill set to serve society, but outside of their professional mandates, so outside of their jobs. And sometimes it's in parallel to their jobs. Sometimes it's after they leave the industry, but they leverage the skill set that they've developed, which is a very versatile skill set. They also leverage the networks that they've developed in order to more explicitly serve society. And these four pillars, in my mind, are a broad, kind of the broad markers of what a virtuous career in finance might look like.
Yeah, thank you so much for this high-level overview. I kind of want to jump right into what you talk about in chapter 1, which is how finance can accommodate, and I'm quoting directly here, and even fuel people's propensity to self-serve because of its complexity, opacity, and the frequent asymmetry of knowledge base between finance professionals and their customers. Could you tell me a little bit about how you define the term asymmetry of information, and if we see these examples in other industries like medicine, consulting, or real estate?
Yeah. So first of all, I think there's asymmetry of information in all industries, but my sense is that it's more pronounced in the finance industry, and as a result, it creates greater opportunity for finance professionals to self-serve. And the way I would think about the information asymmetry, it would be several components. One of them would be, so first of all, there's an asymmetry of knowledge base between customers and finance professionals. That is true in every industry, and it can be very extreme, as in finance, right? If you think of doctors, for instance, surgeons, there's a huge asymmetry of knowledge base, but that may not be as pronounced in, if you look at, I don't know, the bakery industry, for instance, right? So that's the first thing. The second thing is there's asymmetry of specific information in the sense of finance professionals have access to all sorts of pricing that you wouldn't have access to in order to develop the services and the products that they offer to you. So that's another piece. And then I would say, finally, in that kind of broad concept of asymmetry of information, I would also include the fine print, which is particularly important in finance and is available, obviously, to customers, but it's often a way to obfuscate the actual nature of the relationship between the financial firm, and its customers. And so if you put all these things together, my sense is that there is greater asymmetry of information in finance than many other industries, not all industries. But on top of that, you have a situation where most people go into the finance industry because they find it intellectually engaging, but also because it's potentially lucrative. And so the logic of the industry is very much focused on generating profits. That is probably not as much the case for, taking another example that you mentioned, medicine, right? In medicine, you wouldn't necessarily assume that someone went into medicine primarily because they thought it was lucrative. My assumption, and maybe I'm being too simplistic here, but if you're a doctor, if you're a nurse, you would go into the medical profession primarily because you're motivated to serve others and to help others, right? And there are also other reasons why I think the finance industry might be different from other industries. And again, medical profession is an interesting one, but I do feel like there are more safeguards in the medical profession because now you have a regulator that's going to be ultra focused on the new treatments that are available, right? The FDA is going to be incredibly focused on ensuring that these new treatments are okay for their consumers. Obviously, we do have that as well in the finance industry, but I don't think that they would be so precisely focused on each product that comes out of financial service firms. And then the other safeguard is that you would have insurance companies, and the insurance companies are going to be very focused also on making sure that the products serve the interests of the customers and that use them, and that they're not taking advantage of them. Now, this is overly simplistic, obviously, because medical profession has its own issues, and we know that this costs are spiraling and so on. But I do feel like finance is a little bit in a league of its own in terms of that particular concept.
I guess just to jump in a little bit deeper about this concept, could we talk about, I guess, the tech's influence on how finance has kind of become more and more technologically complex and less accessible to non-professionals? Because for me, I think I often hear two non-mutually exclusive sides of the story about finance recent development. One side often says, now there's greater ever complexity of financial products, and therefore it made the industry harder to understand and regulate than ever. The other side would say, yes, our risk models and risk management products have become more complex than ever, and therefore they can help better manage and regulate the industry. There's one side that says fintech innovations like robo-advisors can do tons of good. There's also another side that says the trend we're seeing today in terms of the greater ever complex financial products hurt retail consumers. So it both seem to contain some element of truth. I don't know where you stand on this issue of how financial products have just simply become so complex in the past couple of decades.
Yeah, so I think it goes both ways. My sense is that a lot of innovation in finance has ended up, so if you take the broad view, right, over the last few decades, a lot of finance innovation has gone primarily to serve the interests of the industry, it seems. And if you look at like what are the areas where there's been a lot of innovation, there's been a ton of innovation in derivatives. And of course, derivatives, options, at the core are an incredibly useful financial tool. And they have a fundamental function in supporting the real economy. But in some ways, this felt like that was true of the first generations of these products that came out, where you have the proverbial like option for the airlines to hedge the cost of oil, right? And all these things are very useful. But if you look at the derivative industry today, it seems disproportionate in size to its economic function and to its ability to support the real economy, because now you have these incredibly complex derivatives that that are like traded mostly between finance professionals and don't really seem to have a real economic function. And so I certainly sympathize with the view that innovation has mostly benefited the finance industry, and famously, of course, Paul Volcker said, when asked what was the greatest innovation in finance, I think he was asked about 10 years ago after the global financial crisis, what was the greatest innovation in the finance industry over the last 25 years? And he said the ATM machine, right? Which feels very pedestrian and simple. Since then, I think it has gone both ways in the sense that there still is a lot of innovation where it's unclear the extent to which it benefits society. And in fact, odds are that it doesn't really. It's more extracting value. High frequency trading, for instance, maybe it's neutral. This is not an area I've delved deep into, but it's hard to see exactly the role it fills in the economy. And so there are all sorts of new areas like this, and of course, innovation is going to try to find new areas to generate profits. Now, where it gets a little bit more encouraging is that it seems like in recent years, we have seen innovation that goes towards the common good in the sense that it's genuinely helpful to customers. And those are typically the kind of innovations that create more simplicity and greater transparency, right, for them. And so there are all sorts of apps that allow them to get greater access to their financial products. You mentioned robo-advisors. Those are very helpful, right? I believe that those are helpful because they facilitate that process whereby customers are not inherently fleeced by intermediaries who want to invest their money. They're kind of a channel towards passive investments that are balanced and diversified, which is exactly the kind of investment strategy that makes sense for most people. And so I think in recent years, you would look at some of the innovation and feel, it's very hard to quantify, but I do feel like we're seeing more innovation recently that's is helpful rather than detracts from the customer's interests.
I'm curious about sort of the regulatory aspect of this. How do you think these innovations are shaping the ability of regulators to write and control the types of asymmetry that are coming out of these innovations?
Well, there's a lot of innovation that makes it harder for regulators, right? And what you find is that because there's so much complexity and so little transparency, the regulators by definition are going to play catch up because they're not going to necessarily be aware of what's going on until there's a problem. And this, the perfect example for this was really the global financial crisis, where you see a proliferation of derivatives, whether it's the collateralized debt obligations and the credit default swaps, and the way they were used wasn't clear to anyone in the system because there was no central repository to understand all of these transactions and where the risks were in the industry. And then you have the regulators playing catch up with Dodd-Frank, and I think it's in some ways it's in the nature of the industry because it's such an industry that allows for innovation that is grassroots, and that innovation proliferates very quickly when it turns out to be profitable. It's always going to be difficult for, I think, regulators to be able to be ahead of that, and as a result, there's a fair amount that lies on the shoulders of the financial institutions themselves, and there's an important piece of self-regulation here.
Something that really interested me later on was this quote you wrote saying, unethical behavior can be contagious. In chapter 1, you give an example of Wells Fargo, and you say, quote, at Wells Fargo, unrealistic cross-selling goals, which were aggressively pushed through the retail business, led to the creation of 3.5 million fake accounts by customer representatives who were driven to meet institutional objectives of running afoul an unforgiving corporate culture. The few employees who sought to ring alarm bells were either ignored or fired. So you really seem to claim here that it was due in large part to the culture of Wells Fargo that stemmed, from the standards and stress they put on the employees. However, a company like Wells Fargo could argue that this kind of competitive environment with the right corporate culture is what really drives results and allows them to perform well. Where do you think the corporate boundary between fostering a competitive edge and creating incentives is for unethical behavior? And how does the idea of like motivated blindness play into this?
Sure. So, I delve into the Wells Fargo case in the book, and it's in some ways Wells Fargo is a proxy for other firms. I don't want to create the impression that obviously they went through an enormous scandal, and they were an outlier, but they're also part of a spectrum. And presumably the problems that you see at Wells Fargo are replicated in some shape or form in other firms. What did stand out, though, at Wells Fargo were a couple things. One is that the targets, and specifically the cross-selling targets, seemed to be unrealistic. So there was an incredibly hard-charging set of goals that kept creeping up and that were introduced years before the scandals, the scandal surfaced. And what's interesting about this is that there's nothing nefarious about what they were trying to do in the first place. This idea of cross-selling is a good one. It's in fact, when I spent years in management consulting, and I worked on studies where we suggested cross-selling targets to banks, and it makes a ton of sense, because if you're a bank and you have a set of customers, well, what you find is that it's more profitable for you to try to sell the incremental product to an existing customer than to try to gain an incremental customer. It's an easier path, right? And so what you care a lot about is the share of wallet of each of your customers, and then so focusing on this is completely reasonable. It makes sense as a strategy. The challenge is that when you push that strategy to levels that are unrealistic, and you push your employees to do that, and in their case, their ultimate goal was to try to have to sell 8 products to each of their customers. And as you can imagine, 8 products, that's a lot, right? I mean, maybe you have a saving account, you have a checking account, maybe you have a mortgage, maybe you have insurance, but 8 is hard. And so you take those unrealistic goals, and then on top of that, it seemed like there was an informal culture at Wells Fargo that was all about, all we care about are the outcomes. And we don't care so much about how you get there. And the confluence of unrealistic goals and an informal culture that was very much about the end results ended up generating that scenario, which from the outside seemed completely implausible. I mean, how is it possible that so many employees, I think it was over 5,000 employees, were involved in creating fake accounts, and you're talking about 3.5 million fake accounts. And by the way, this was not their intention, obviously, because it's not like they were scheming at a strategy at a strategic level at the firm to say, hey, let's create these fake accounts, nobody's going to notice. Because at the end of the day, when you go through these fake accounts, it didn't really add much at all to their bottom line. And in fact, many of these fake accounts didn't even generate revenues. So it was a unfortunate byproduct of these two things, right? Unrealistic goals, an informal culture that really focused on end goals over at all costs. And to your point, about motivated blindness, this is where it's reflective of broader issues in the industry. And I think the broader issues are, one, structural factors that affect every large bank, which is that since the early 1970s, most large banks have been publicly listed. And this is challenging because now they're at the mercy of public markets. and public markets have been increasingly focused on quarterly returns. And so now they're really focused on trying to show returns over really short periods of time. And that is often in conflict with the fundamental business of serving your customers with your customers' interests in mind. Right? So that's one thing. So you have a structural issue that is true for Wells Fargo, but it's true for every other listed bank. And then you have this, I think, environment, which is specific to finance, and in that it really offers fertile grounds for cognitive biases. And here, I think Wells Fargo is a great example where you have a ton of pressure as a relatively low employee to hit your targets. The targets are unrealistic. Through its informal culture, the firm has shown that it rewards people who get to these targets no matter how they get there. And now you're so deeply embedded in the web of pressure and incentives that you end up being oblivious to the moral component of your decisions. Now, this is not to say these were all great people and they did this not knowing what they were doing, because that's probably taking a step too far, in the sense that a lot of them actually like faked email accounts, right? And I mean, you don't do that unwittingly, but it's still the case that you know, there are cognitive biases that certainly had a role to play. And you mentioned motivated blindness. There are clearly like senior people that noticed what was going on below them and may have you know, had this bias where they tend to not process all the information when it tends to go against their own interest. And so, and you see this through the industry, right? I mean, Wells Fargo is an example, but there are like, you know, multiple other examples that have come through since then, and you know, just in recent weeks, like the Wirecard scandal with the auditing firms. These are, you know, great examples also where presumably cognitive biases had a lot to do with what on the outside seems like an outrageous end result.
I guess I'm curious as to how you think companies should approach and create both an informal and formal culture that is competitive but doesn't motivate unethical action. I know in the third chapter, you mentioned the best way to have a virtuous career is to join a firm that promotes this kind of behavior, but how do you create such a firm to begin with?
That's tough. That's tough. I mean, for one thing, it often has to do with the horizons that you're dealing with, right? And the longer term your goals are, and the more you motivate and incent people and reward them on longer term performance, the more you're likely to be aligned with your customers' interests. Where you see the conflicts often is when you need to show short-term returns, and that's when, you know, it becomes impossible, right? Like it becomes impossible you're solving for two constraints that are contradictory. And so if you're setting up a firm, the more you can create your incentive system for longer term goals, the more likely, or the less likely you are to spur that kind of behavior. But you know, I don't want to sugarcoat it in the sense that it's hard, right? Because in order to do this, that means you're going to be willing to take time to show results, and often you have to raise capital if you're going to create your own firm. And in order to raise capital that is longer term, that's really hard. You know, most investors have also a short-term perspective, so you need to fight for that because that's not where the industry is, that's not where the norms are. And you know, and now I think it's helpful that you're seeing more and more long-term investors led by those who are naturally longer term in their outlook because they have permanent capital, whether it's sovereign wealth funds or the endowments or the pension funds. But it's tough.
I know in the beginning of this discussion, you mentioned that girl that came to talk to you at the beginning of class and was like, I want to hear about like good cases. I'm curious if you can think of any firms that have these traits and have these sort of long horizon mindsets that helps them achieve this culture balance.
Yeah, so, and I certainly write about them in the book, and I would say, I mean, the first one you would have to bring up here is Vanguard. And Vanguard in some ways it's such a, there's a risk that other firms can't really compare themselves to Vanguard because it's such a one-off, but it's still worth anchoring the discussion on Vanguard because it does reflect so many of these values. As most people know, Jack Bogle founded Vanguard in the early 1970s, and with a view that most individual savers would be much, much better off if they just put their savings into passive investments, right? Passively managed investments through passive indices. And the research has shown this since the early 1970s. And what's been curious about this is that it took 40 years for the research to seep into public consciousness. And now you're seeing the revolution taking place now, but it took 40 years. But he set up the firm really to push that revolution. And he did it in a way that was extreme in a sense, because not only he said, we're going to focus on passive funds, passively managed funds that just simply replicate indices, because one, it's lower costs for the customers, and it's much better for them over time. But there's a real trade-off, right? Because that means you're not paid nearly as much. You're just as a fund manager, what you're doing is more like overseeing a back office function. So that was the first thing. The second thing he did was to set it up as a not-for-profit. He didn't have to do that, but he set it up as a mutual. And he said, so that means like the excess profit that they make, so after, of course, like all the bonuses and so on, are passed on to the customers. And so as a result, it lowers the cost even further. And that model, as it gained traction, and it's still unclear to me why it didn't gain traction earlier than it did, but as it gained traction, it's almost virtually like you can't compete against this, because of course it's the right product for most people. And now this industry has taken off dramatically and is dominated by Vanguard and BlackRock and State Street, and that's really a force for good for customers. So I think Vanguard was set up, it was anchored in values that it was really all about the customers, right? And I think, I mean, to the extent that we talk about virtue in finance and, what's the way to be virtuous in finance? Well, if you work for Vanguard, it's hard not to be virtuous in a sense, is my personal opinion, because it's just a force for good. Now, that may be too extreme of an example because, most of finance, first of all, it's a not-for-profit, right? So, but even if it were a for-profit company, it would still, I think, fulfill its social role admirably. There are other firms. I mean, sticking with the asset management industry, I think firms like Dodge and Cox are interesting. This is an old firm that was founded decades ago, and it's kind of a discrete firm. And what's interesting about them is that the real criticism of the asset management industry over the years was that they were essentially overcharging customers, and because their customers on average would have been much better off just getting a passive fund, replicating the market for almost nothing, right? The cost of getting that is very, very low, but they were charging a lot of fees for actively managing funds that were seeking to beat the market. But when you look at the numbers, the vast majority of these funds never beat the market over time. And so you were worse off. And Jack Bogle, who ended up being like the real anchor to the seminar I've been teaching for the last 10 years or so. For 7 years, he came to the seminar and spent time with the students talking about this. He would always kind of frame it as the real skill set of the asset management industry is marketing, not investing. And it's true. They spend so much capital, so much money marketing, that money had to be passed on to their customers, right? So by definition, that increased the cost of their product. Dodge and Cox is an interesting one because they don't do marketing. So they entirely focus on the investment function. And as a result, they're able to have lower fees than other firms. Now, this is one where the commercial interests might converge with virtuous behavior, but there are trade-offs for them, right? Because they're not as well known, it's more discreet firm, but in a way they're doing the right thing. So there are all sorts of firms out there that are quite thoughtful about the way they approach customers, the way they interact with stakeholders.
I guess just to quickly push back on that point, Professor de Swaan, when people think about asset management industry, when people think about passive investing, mutual funds, it often, the image that pops up in the mind is often, a relatively slow moving, less of a cutthroat kind of environment compared to other niches in the finance industry. For example, if you're a VC firm in Silicon Valley, where you are expected to go meet 200 startup founders every week to get those deals. If you're in like a mega fund like Blackstone and you have 8 associates and only 2 of them will eventually become vice presidents, it becomes extremely cutthroat. If you are at the trading floor, typically very stereotypically described as the Goldman Sachs or the Morgan Stanley trading floor, where people are shouting at each other trying to sell something. So I feel like those are the places where it seems almost impossible to create this kind of everybody is happy, everybody creates value type of scenario, right? Or
yeah, no. So I this is an area that I spend time thinking about, because obviously I work in an investment fund myself, and I think this is one where so this is an emerging area of research. So there's not a huge amount of empirical analysis on this, but there is some, and it goes to the core. I mean, to the extent that you're talking about investment firms, it goes to the core of which are the type of firms that create social value, and which ones are the ones that are more likely to extract value from society. And I mean, to this point earlier, I think it's very important to know, because if you're entering the industry, it's much easier to try to position yourself by going into a firm that inherently creates social value, because you're more likely to end up being virtuous yourself by being in that kind of firm than others. And I mean, you mentioned venture capital firms, and this is an interesting one, because if you look at traditional alternative asset investment strategies, if you look at the empirical research of their impact on society, venture capital is the one where there seems to be the least disagreement about in terms of the research, in that it's helpful to society. And it's in terms of, so, how do you think about whether it's helpful to society? Well, I think of it in one of 3 ways. If you're looking at an investment strategy, one is that it has to generate attractive financial returns. right, over time. Because if you don't generate attractive financial returns over time, you're just unsustainable. So that's kind of a litmus test, right? But then, so let's assume that's the case, and then what happens next? Well, the question then becomes, do you support the real economy in any shape or form, right? And that's not an easy question to answer often, because in some ways, it's one that might be more relevant for the extremes. So if you're lending to small and medium-sized businesses, odds are like you're supporting the real economy, right? If you're trading complex derivatives that you're structuring with an investment bank and some option that has 3 legs that you concocted, and on the other side there's no counterparty, it's the bank that are putting these pieces together, it's hard to make the point that you're supporting the real economy, right? So that's the second piece, is are you supporting the real economy? The third piece to this, which is not relevant to all investment strategies, but relevant to some of them, is are you improving the underlying asset or business that you're investing in? And that's really the realm of what I would consider the activist strategies. That's not the way people usually use that term, but I would say venture capital, private equity, shareholder activism would fall under this. And venture capital, when you look at it, so what's the impact on society of venture capital? The indirect impact, not their returns. So their returns over time have been strong relative to their risk benchmarks. But when you look at what's the impact on employment, what's the impact on innovation, on R&D, and generally the spillover effects are positive in that industry. And they're in fact so positive in terms of supporting the economy and pushing innovation and so on, and enabling innovation, that it's often become a matter of public policy for certain governments to try to develop the VC industry, right? So you see Japan, for instance, or Israel have proactively tried to develop their VC industry. Now, this doesn't mean that there are no issues in venture capital. Right? Like there are a lot of issues in venture capital, and one of them is, well, first of all, when you look at their returns on average are attractive, but there's no such thing as the average venture capital return, because it's incredibly skewed towards the top 20% of the firms that generally account for all of the profits in the industry, right? So, and then when you look at the effect on the economy, there is real herding behavior in venture capital, where there are areas that are fashionable in a sense, they're trendy. And that's where everybody in the industry is going to invest. And so that leads to overinvestments in overinvestment in a few areas, whether it's, I don't know, like augmented reality, smart transportation, gaming apps, right? It doesn't mean that it's great that we're investing in smart transportation, but you have this herding effect where everybody is, there's so much investments going into that. And that means the corollary is that, the flip side rather, is that there are a lot of areas that are being unfunded and where the venture capital industry is not stepping in. So there are issues with it. But I would say, by and large, if you look at the data, it's supportive of, if you work in the VC industry, you're probably creating value. Private equity, the data is not as strong, but somewhat supportive. Shareholder activism, surprisingly, the data is not particularly supportive. And I would say surprisingly, because the mandate of shareholder activists is to improve the companies they invest in. So that's a little bit disappointing, and that the data is not more clearly showing that it creates social value.
I guess I was probably also very confusing in phrasing my question. I guess there were two parts to our discussion. One is, within a corporation or investment firm or any institution's internal organism, how a leader or a culture can be established to encourage better incentives. And the other side is how this firm itself or this industry itself may have a positive or negative impact on the society. And I think you obviously touched on both, but just zooming in slightly more, I guess, on the first part before diving into more about the industry's impact on society. There was a very, very interesting part that you quoted Stanford behavioral academic and this self-proclaimed realist, Jeffrey Pfeffer, who says that servant leadership is the exception, not the norm among corporate leaders. A self-proclaimed realist, he argues that in the real world, assholes tend to win as much as we would like to observe the opposite. So you give a counterexample and you argue that this is not often the case. So I'd love to hear a little bit more of your thoughts on, I guess, within each firm, how exactly one could help build out that nice culture.
Yeah, and first of all, just to be clear, I think Jeffrey Pfeffer makes an argument that is completely depressing. I mean, it's super depressing, right? I mean, he's saying like really like selfish people are often the ones that make it to the top, and unfortunately, it's his argument is relatively convincing actually. And so just to be clear, I'm not suggesting that being a better person will make you more successful. And I wish I could make that argument. But the argument that I make is slightly different, which is trying to be a virtuous person will, I think, for some people, make their life more fulfilling in the Aristotelian sense of that concept. And it will allow you to be successful, and it can allow you to be successful in the industry to the extent that you broaden your definition of success. But I don't know that it's going to make you more successful. So that's an important piece, and which is why I reluctantly brought up Professor Pfeffer's research, because it's depressing and it's probably right. Now, there's a counter piece to this, which is that it's not always the case that self-serving, greedy, narcissistic people get to the top. And this is where there's that ray of hope. And it's the wonderful research, the wonderful book by Adam Grant called Give and Take, which shows that in the industry, if you bucket people into different categories in terms of how they think of reciprocity in their interaction with peers and colleagues and so on, it's actually the ones at the tops are not the takers who try to extract value from you. It's not necessarily the matchers who try to simply reciprocate, but there's a subset of givers that do very well. So that's very encouraging, right? Now, to your point, Tiger, around like how do you establish a culture at a firm that tries to promote these values? Well, one is, I think it's all about the informal culture, right? Because every single finance firm in the world will say that they prioritize their customers' interest. So what they actually say doesn't mean much at all. It's the informal culture, and it's about how do you reward people internally? That's the key, right? Because that's what people are going to look at internally in terms of who gets to be promoted, who gets to earn more. And that will, because for all the talk about, trying to be thoughtful about virtue and so on, you're driven by incentives. And the incentives are going to shape that informal culture. So it's all about, if you want to create that informal culture, then then you have to back it up with, here are the people I'm promoting, here are the people I'm rewarding, because they're actually looking out for the customer's interests. Maybe they have tremendous followership internally, right? Like people who are devoted to them, regardless, because they're empowering their colleagues, they're helping them develop, they treat them with dignity. Like so those are the things that you would look for, I think, in priority.
Would you say it's fair to say that you can only really create new systems with this, with a good individual at the helm, or can you actually change existing systems that may not have a great culture? And how would you go about doing that?
Yeah, so that's hard. That's hard, right? And this is where I want to be realistic, because the book is primarily targeted at young folks who are either considering the industry or who are now in the industry. If you go in to whatever investment bank and you're looking to wage your personal vendetta, you're just not going to last long, right? So that's not going to be necessarily a helpful approach. So you need to. So the primary thing is, when you're going into the industry, or whether you're in the industry and thinking about your role in society, then it's about picking your spot, right? So there's a subset of areas in the industry where you would certainly argue it's more conducive to creating social value, and there are certain firms whose culture is more conducive to that. But it's not easy, because very often for these firms, you don't know. Like you have to go deep inside to understand what the internal dynamics are. So I would say first, it's about picking your spot, and then within the organization, because obviously a lot of my students are going to find themselves in organizations where they look around and they might say, wow, this is pretty sharp-elbowed. And then it's about being thoughtful about like thinking about that framework as a guiding principle, but not using it to wage a personal vendetta. And frankly, a lot of that framework over time internally in organizations that are sharp-elbowed and that are not thoughtful about this will be about asking questions, right? And it'll be about trying to create greater transparency. It may not be about advocating from day one, because I do feel that in a lot of these organizations that you might consider, however you want to describe it, a lot of them are populated by very smart, thoughtful, well-intentioned people, but the logic of the industry makes them overly focused on that short-term incentive. And the question is, how do you create more transparency on these aspects, or more relevance on these aspects that are not getting embedded in the decision-making process, right? And that's where I think that new generation coming in that is probably more tuned in to these issues can make a difference over time, but it's not going to be overnight.
Professor de Swaan, I need to ask you a very long follow-up question, just trying to play devil's advocate a little bit about this point, because I think you brought up a fascinating point about how the system often incentivize individuals to focus on short-term incentives. And therefore, if we can educate a young generation of leaders to go into the industry and become individual actors of good faith, that could help change the system. So I was listening to this podcast interview between Eric Weinstein and Daniel Schmachtenberger, who is this very eccentric guy working on long-term civilization design, stuff like that. And they talked about one concept, which is called the multipolar trap, or you can call it as this kind of zero-sum game, as a way to characterize the rivalry between human beings, in the sense that if I got a promotion, then Roopa cannot get it. If I get some intangible resource that is limited, then Roopa cannot get it. So therefore, it is very easy for Roopa and I's competition to devolve into a zero-sum game, and therefore be in this trap. And therefore, in order for us to fundamentally get out of this and disincentivize unethical behaviors in finance and business, it seems that you would need a fundamentally different system of better sense-making, better choice-making. You need to have better resources that everybody can get promotions, everybody can feel comfortable and happy and feel like they're getting the recognition they need and considered to be successful, that they don't have to climb up the corporate ladder, that I don't have to stab Roopa in the back. Because then what would happen is that if I'm a good person and Roopa stabs me in the back, then I say, okay, that seems to be the person that's doing well and somehow she's getting the resources. Then everything kind of devolves down from there. So I'm very, very pessimistic in seeing a way out, because you could educate these very, very nice freshman students who, after getting their first internship, they realize, oh my God, that kid just sucked up to the boss and got a much better deal than me. So yeah. I'm sorry for my very long.
No, but you're right. It's tough. It's tough, and that's why I want to be realistic and say, look, the easier path here is to pick your spot in the industry. Now, to your point, a lot of spots in the industry are the ones where you're going to find yourself are not the right spots necessarily, and it is what it is, because you're motivated to go there because it's going to be great training, it's going to be great on your resume, it's what everyone else does, and that makes a ton of sense. And the question is, what do you do internally in order to challenge these norms and culture? And here's my sense for what you can do if you find yourself in that position, right? Like you're a senior at Princeton, you get a job in investment banking, you start and you're doing M&A, and for whatever reason you feel like you read the book and you see like 7 red flags, you know, relative to the role model individuals and firms that you read about in the book. So what do, right? And my point is, you shouldn't necessarily like get out. I don't think that serves anyone, because by being thoughtful about it, you can make a difference. But by the same token, I don't think you should like wage a campaign internally right away, because that's not going to help you, right? So there are a few things I would say. One is that within these organizations, it is always helpful to be skilled at the core function of the organization, because that will afford you a lot more credibility. And that will, one, make you more valuable. People are going to listen to you more, and you're just going to have more impact, right? So in a strange way, to be virtuous effectively also implies that you should try to develop your skill set very diligently. Like, to be the most highly skilled M&A banker, if you feel like your M&A firm or department is not particularly virtuous, in some ways that will afford you much greater opportunity to change things than if you find yourself floundering and giving up and not learning the skill set, right? So that's the first thing. The second thing is, I would say, to be realistic, pick your spots internally. And what you could do is, at any given point, there are a few themes inside these firms that are about improving the world, like ultimately, right? Jump on that bandwagon and pursue that, because that's going to be aligned, right? So if you think about like, what are the themes that are high priority today at these firms that are helpful to society? So one, I would say the shift from active to passive management, right? 2, ESG. That's a huge, huge theme that has become almost overnight, like an enormous priority for these firms, right? So that would be one where you could go in. And third, like if I'm sitting here, I just graduated from Princeton in May, and I find myself in M&A. What's another theme that is going to tremendously resonate? Diversity, right? So raise your hand and say, I want to be deeply involved in that effort, right? So there are ways, I think, to be strategic about where you can add value internally and push the ball forward.
So I want to kind of come back to this third pillar that you mentioned, which was treat others with dignity, and it relates to your point about creating diversity within a firm. I'm very curious as to whether we're actually seeing the system in these new firms actually working. You give an example of Bridgeway Capital Partners as a firm that does a great job managing inequity within the firm by capping the highest partner's compensation at 7 times the lowest paid individual. Can you elaborate on why this is a great example of humanistic leadership? And why do you think that partners choose to stay at this firm if they could be compensated somewhere else?
Right. So one of the issues, of course, that we've seen in our society over the last few decades is rising inequality. It's likely that the finance industry has contributed to this. And the question is, the impact of the finance industry is on everything outside of the finance industry, of course, but to the extent that we look inside the organizations of financial firms, it's also useful to think about the inequality within them. And this idea that the CEO or the senior management should make 100 times what the lowest paid person speaks to certain values, which can be good, right? And it can create a lot of motivation to excel. And there are organizations that work very well as star systems, right? And so the star system is the one where, at its extreme, people sink or swim. The firm is going to inherently focus on those who rise very quickly and devote all of its resources to these stars, but it generally promotes a culture that is competitive internally and where you might see a little bit less of the virtues that I see in some of the role models I studied. And so to the extent that you have a choice and that you create your own firm, I do feel like this idea that you would not create this gigantic gap between the top performance and the bottom performers also creates, I think, an environment where you can nurture talent better over time, because what you also find is that the people that are stars at financial firms are often people that come in and do well because they already have these inbuilt networks at these firms. And the reality is that there are a lot of people that are not going to rise and perform so well in the first few months, few years even, because it's going to take longer time for them to get to that level, simply because they don't have these inbuilt connections. And they came in and they weren't on the lacrosse team at Princeton, and so they weren't at the same eating club, right? And who are the people who typically have a lot of these connections when they come in? It's often males, and it's often white males, right? And so I do feel like as a long-term HR strategy, I like the idea of Bridgeway as an example of a firm that likes to think of itself as a team rather than a collection of stars. Right. And so that's why I thought it was interesting to highlight. Now, the other point is that the fact that they have that policy is indicative of 17 other things that they do well in that respect, right? Like, you generally don't have that one policy and then you're not thoughtful about other things. It's reflective of a lot of other things that would nurture a culture that is going to be very supportive of colleagues, and that's going to focus on their development and focus on the development of all the employees.
Professor de Swaan, I think going back to my earlier point that we were talking about both impact of individuals within the system and how to make an organization better, and also the second part, which is an organization and industry's impact on the world. I think we're kind of going into the second part now, which is how these industries and these firms have a net positive, or whether they do have a net positive impact on the world. And I do actually want to hear your thoughts on this, because we're talking about ESG funds, we're talking about impact investing, we're the green funds. So many names have popped up these days and every single firm says they have a social mission, they donate their profits or whatever. And what really bugs me is that for students who often say, I want to go make tons of money on Wall Street so that I can donate those profits to charities. Or they say, I want to do tons of social good by first making a lot of money. And then, so, and it bugs me by saying, why don't you just directly go do the good thing? I mean, so it seems to me that the finance, again, this might be a very cynical and naive view of seeing things, that ultimately it's still about making money, right? Which is fine. I mean, and it's about reducing certain transactional frictions in this world, which serves a foundational importance. And it is good that we're seeing those positive developments within the industry, that people are becoming more aware about those issues, whether it's diversity or inclusion. But fundamentally, again, the system is about making money, and instead of having to brand yourself as some sort of a mission, why don't you just do it?
Right. Yeah, and so there's a fascinating philosophy paper that was written by an Oxford philosopher, young Oxford philosopher called Will McGaskill, and we actually debated in class. There's a class that I do on the ethics of career choice, and are there careers that are more ethical than others? Right? Are you inherently a more ethical person if you become a doctor versus, I don't know, like an M&A advisor? And he makes a very controversial point, which is that if you want to do good in the world and you have a lot of options, so say you graduate from Princeton and you have high grades, and so you have options, should you work at Goldman Sachs, or should you work at TFA, Teach for America, right? And for most people, the obvious answer, of course, you're going to work for TFA, right? I mean, that's like a wonderful organization. It's devoted to improving the quality of public education and so on. And he says, no, you shouldn't make that decision. You should go work for Goldman Sachs, because what you should do actually is work there, become a partner, but along the way, live like a grad student and pay the delta and donate the delta to TFA. And as a result, instead of having one person that goes to TFA, you're going to fund 10, 20, 100 at TFA, right? And so that's the argument. It's an extreme argument, and but it's a very tight philosophy paper that he wrote, and that was the genesis of I think a broader movement of effective altruism that I think makes a lot of good points, and as I think garnered a lot of sway on campuses. Now I'm against that idea. Like the fundamental idea of the paper, I don't believe in, because I don't believe we're wired in that way, that if you want to do good in the world and you end up, being an M&A advisor at Goldman and working incredibly hard, and that you're just not going to perform. It's going to be hard for you to perform. I think it's actually going to be hard for you to maintain the discipline of giving throughout your career in the way that he advocated. And just to be fair, I think over time, he has softened his position to make it more practical and realistic. And his latest book, I think, is very thoughtful on this. But still, it is the case that, in my mind, I wouldn't necessarily tell people that you can only be virtuous by working for Teach for America or being a doctor or something like that. And that's the point of the book, is that the finance is an industry that is complicated and that is very conflicted, and that over time has arguably swayed away from its primary mission. But at the same time, I do feel like there are ways to be virtuous, even in this context, right? And as a result, I think you can go in and do good for the world, and ideally, more simply, by picking your spots. But even if you don't pick your spot in a sense, and you end up in the sharpest elbow area, I think over time there are ways in which you can act virtuously. And now I don't want to dismiss this idea that you can do well also by donating thoughtfully, generously, but it has to be accompanied by thoughtful behavior inside the job. Like, you can't just pillage and then donate, right? And
yeah,
and I'm this is too extreme, of course, but yeah.
I think I keep throwing these radical theses at you, and we gradually tone them down and moderate them back. And I think you make some wonderful arguments about how individuals, first of all, can make their own surroundings and their own environments, their own microcosms, a better place, and making the people around them better. And then try to be more thoughtful, live more thoughtfully, donate more thoughtfully, and one should live out one's mission and life like that. But I do want to ask your thoughts on I guess the finance industry, because you were talking about how one could make the money by pillaging and then donating them. But do you ever feel like parts of the money-making operations in the finance industry are simply quasi-Ponzi schemes? And I'll give you, again, a very extreme example, which is that if a private equity firm says they manage some pension funds money and doing good, but in order to maximize the returns for those pensioners, they have to first buy out a factory, fire a bunch of people, maximize the profits, and then and basically they return those profits to the pensioners they fired, or some other pensioners, other people fired. And it just seems that, okay, instead of saying you guys want to do good and whatever, maybe don't do anything. Maybe try to not harm first. And yeah. I think that's another central argument to a lot of people. Is, I mean, many people like Nassim Taleb who critique this, even policymakers who say, don't think about how to make the financial industry a better place or a more stable place. You should try to do least harm first. And I think I would love to hear a little bit more thoughts on whether throughout your career you ever look at something you go, that does not sound very nice to me. Yeah.
Look, right. Yeah. I mean, sure. I think there's been greater awareness of this since the global financial crisis, because I think there was a period in the 1990s and 2000s where so we went through a lot of growth, both the finance industry and advanced economies. And a lot of the focus of the industry, of academic research and of the media, was around this idea that finance was a force for good and that it helps society. And then you have the global financial crisis. And obviously that's a traumatic event that impacted millions and millions of people terribly. And the finance industry was at the core of it. And so since then, a lot of media's attention, a lot of academic research has pivoted to what are the ways in which finance is not always a force for good in society. And we've seen a lot more examples, and we have a better understanding. And so, yes, you are right that there are lots of pockets in the industry that if you shine a light on them, they look terrible, right? The example of some of these retail products in Europe that are structured derivatives, so where there's a huge asymmetry of information between the finance firms and their customers, and more often than not, what they end up doing is targeting the most vulnerable customers, because they're the ones who are least likely to understand the product, and having them overpay for the product, because there's no way they could ever price that product well. If you're the customer, there's no way to understand how to come up with the right pricing for these products. And there's a very interesting research that shows that these types of retail products in Europe are like, they target very specifically not the people like me, but the people that they think are less likely to understand them, right? So you know, those are concerning, and there are like extreme examples of, you know, I know in France, like in the savings, local postal offices that sell savings products, you end up seeing like 6-legged options that are offered to retail customers in ways that are impossible for them to understand, and importantly, to understand the pricing of. And of course, they're going to be overpriced, right? And what you find is that the more complex these retail products, the more profitable they are for the finance firms. Credit cards is the same thing, right? I mean, you see a lot of behavior in the credit card industry that suggests that they're targeting the most vulnerable people, and it's incredibly, you know, the fine print is really hard to understand, and on average it's 5,000 words, and it's at a reading level that's greater than the average reading level for US citizens, and so on. So you see a lot of that egregious behavior. And you mentioned private equity. So private equity is interesting because on the whole, the data suggests that it's helpful. But we also know that there are a lot of instances of excesses. And one of the trends that we're seeing right now is a rise in dividend recaps, in dividend recapitalizations. And that's a trend that's problematic. Everybody knows it. But you're seeing it happening right now, which is this idea that you know, private equity firms, and particularly the subset that do leverage buyouts, buy these mature firms, and they typically, so they take control, right? So they usually buy the whole firm, or at least take control of these firms. And as soon as they acquire them, they're going to lever them up dramatically, and very early in the process will do a special dividend to the shareholders, meaning them. And so as a result, they can recoup very early on a large part of their investment, which means that now their interests are less aligned with those of the company they acquired. And we know in the past that they've levered up too much, to the point where as soon as the cycle turned, a number of these companies would go bankrupt, right? And so you can see here like challenges in that industry. But yes, I mean, there's no question that there are problematic areas and you know, things that look terrible, and the best thing you can do is shine a light on them, because now that's going to create a lot of pressure, whether it's the media, whether it's academic research, and eventually it can seep into regulation too.
I think we've talked pretty extensively about your observations of, you know, the financial industry, but I'd love to hear a little bit about your experience working in finance, your career trajectory. And I heard that like Cornwall Capital is related to the firm like Big Short. I'd love to hear about how you arrived to be a partner there.
Sure. Well, I mean, my entry point into the industry was a little bit non-standard. You know, I think I mentioned to Tiger before the podcast that I actually studied history of art and political science as an undergraduate. I thought I wanted to do a history of art PhD. I spent a summer working for Sotheby's, and then decided it wasn't quite for me, and that you can have a passion for art and continue through your life having that passion and engaging in art without making it your profession. But then I studied in grad school public policy, economic development, and I ended up working at McKinsey & Company, a management consulting firm, for a number of years. And I think it's a wonderful firm. It's Of course, it's had its shares of issues in recent years, but it is a deeply, deeply thoughtful firm in the way it treats its employees and develops them. And I went there thinking I would spend a couple of years, and of course I ended up spending 5 just because it was so interesting and engaging. But eventually, I moved to the buy side, and with this idea that investing could be a force for good because you're allocating capital, and could that perhaps have a role in the economic development cycle. And so I started, and I became, I went to work for a hedge fund, and it was a long short equity hedge fund focused on Asia. And it took me about a week to realize that it would have literally 0 impact on economic development in Asia, because you're basically trading in the secondary market. So it's basically a bunch of hedge funds trading between each other, buying and selling shares, and it has no impact whatsoever. You know, and maybe I could have figured that out before, but it was incredibly interesting. It was right at a time when capital markets were exploding in Asia, and I was seeing a lot of fascinating trends that were related both to the development of financial markets in Asia, but also just in general to the rise of Asia as an economically powerful region, particularly China, and a lot of other countries like India. And at that point, I ended up teaching because I taught as a grad student, and that's my true passion is teaching. And so then I ended up dividing my time between teaching and being an investment professional. And so teaching for the last 12 years at Princeton, and working with undergrad students as a faculty advisor, and doing a lot of things that have been enormously privileged to be able to do. And to your point about Cornwall Capital, so this is an investment firm that I've been part of for the past 10 years or so, and it's a small firm. I would say we're very quirky, we're very unusual, in the sense that at the core it's a family office. So it's the family office of the founder, my partner, Jamie May, who created the firm in 2002 as a family office. And his father had run one of the oldest private equity fund in the US for about 25 years. And it's a very quirky firm that's very, very thoughtful. And it has the unusual distinction of being able to invest in just about any place, anywhere. And so I will spend part of my time looking at global macro investments, but also spend a lot of my time doing shareholder activism in Japan, one of the themes in recent years, and also be engaged in venture capital. So it's just I've been incredibly lucky to find partners that are smart, but also I think have an interesting approach to the world, and that's particularly true. I think Jamie May is a very thoughtful person. And yes, and you mentioned they were involved in, so this is a very discreet firm in general. It's a very small, discreet firm, but they were written up in the book by Michael Lewis, The Big Short, because they were one of the few firms that saw the subprime crisis come, and they positioned themselves and shorted some of the securities that reflected subprime mortgages, but that was before I joined. I joined them about a year and a half, a couple of years after that happened.
Yeah, it is one of the many hedge funds with no website. If you Google them, it's just one address.
We've been very successful at being discreet, I think. since the book, because obviously there was a movie after that, and we and I think in the movie we're called Brownfield because we asked not to use the Cornwall name.
I won't ask you to divulge any of the investment secrets, but I do also want to quickly follow up. So you said you were an art history major. I studied art history in high school. I applied to Princeton as an art history major. I actually worked at Christie's. I didn't work at Sotheby's. So it's I worked at Christie's my freshman summer, and then my sophomore and junior summer, I subsequently worked at a private equity firm and investment bank. So completely moved away from that. So that's my full disclosure. But I guess quickly following up about your teaching involvement and also your kind of professional services. I feel like there are probably not enough communications between people in the business or actual finance world and the academic world. Would you say that? Because I talk to grad students in finance or finance professors, and I read books, and people often say that the academia way of looking at things are sometimes inaccurate, or they're slow, or they try to characterize the finance industry through some model that is probably not accurate. And tons of scholars have even critiqued traditional finance scholars. And I would love to hear a little bit your thoughts, because you are very much a theorist and practitioner. So.
Yeah, I actually think that has evolved. That's been very true. But I do feel like the global financial crisis changed that because there was an enormous amount of soul searching, I think in economics, in academia, because of the fact that prior to the global financial crisis, one, not a lot of academics foresaw that the system collapsing, and two, a lot of the field generally favored theoretical research over empirical research. And since then, my sense has been that there's been a pivot where the field has, first of all, tried to understand where did it go wrong and try to improve itself, but also there's been greater and greater focus on empirical research and on making the research increasingly relevant. And you see that in places like, so I'm affiliated with the Bentheim Center for Finance at Princeton. And that's certainly a place where there's a ton of research that goes on that's completely relevant to the real economy and to the financial system and the risks in the financial system. And there's also the Julius Rabinowitz Center for Public Policy and Finance that does a lot of research in the same vein. So I do feel like that's improving, actually.
I kind of want to ask a question more broadly for all Princeton students and beyond, thinking about a career in finance. In terms of maximizing social good, is it ever the right decision for someone to enter finance as opposed to becoming a doctor, working in some other career with more direct benefits for society? I think sort of more plainly, should kids go into finance, and should this many kids go into finance? And how can individuals sort of best handle the fear of being corrupted by finance when they're in that industry?
Yeah, so I think one is, it depends very much on where you are. So the answer is going to be very different if you're in New York City versus whether you're in the developing economy. Because first of all, the research tends to show that the growth of finance tends to be positive on economic growth, economic development, up to a certain point. And that there's a point at which there's such a thing as too much finance. And we've been there in the US, right? And the global financial crisis was a perfect example of that. And so, but there are a lot of developing economies where that more finance is better. And it's not just more finance, it's more that transition from a bank-based financial system to a capital markets-based financial system. So it's really like a true development of financial institutions, of modern liberalized financial institutions, and where if you're a Princeton student and you're going back home, say, to a developing economy, yeah, you can have tremendous impact there, and I wouldn't question it for for a minute that you're going to have a positive impact. I think that the question becomes tougher if you're looking to go work in the industry in the U.S. or in New York, and again, I think in some ways I overly focus on the parts of finance that are that create question marks, and that tends to be Wall Street broadly defined. But there are lots of finance, whether it's commercial bank, insurance companies, payment systems, where you would very naturally support the real economy, be helpful to society. Now, I think so say you want to work in New York at one of the banks or a hedge fund or private equity fund, then I think it's about picking your spots, right? As we've talked a lot about, it's about trying to pick the right spot in the industry, or at least at a minimum being aware of what the impact of that industry is. What are the things that industry does that are helpful? What are the things that are not helpful? And then within that subsegment, pick the right firm, right? And then once you're at the firm, and maybe you find, so if you pick the right segment, you pick the right firm, and you're in the right country, then you don't have to worry a lot about your impact on society. But if you end up at at the opposite end of the spectrum, then it goes back to, okay, what can you do from the inside? And I think the framework is a good way to at least think about, like, what are the areas to be mindful of, and then be strategic about trying to improve from the inside these different areas. And then and then it may be that at some point you can't do it, right? Maybe you've tried and you realize there's just too much of a conflict of interest, and then it's a question of values as to whether you're comfortable staying in or moving to another part of the industry where these interests are going to be more aligned.
Professor de Swaan, we don't want to take too much more of your time, because I know this conversation has been so fascinating and gone on and on. I do think probably to wrap up, before I ask you the policy punchline, I do think you brought up so many very intricate points at the end, especially about how students should think about whether they should go into finance or not. And I think it's personally, me coming in as a freshman, immediately seeing your freshman seminar listing, ethics and finance, I think what attracted me personally wasn't the ethics part, it was probably the finance part. And that is probably the reason what attracted a lot of students. And somehow we're just seeing how so many students want to go into finance these days for some reasons, and maybe for very valid and objective reasons, that it is an industry that has a lot of information and talent, but also sometimes not for so valid reasons. And I think your book and your seminar and this conversation do such a great job in terms of dissecting some of those issues and laying out a sustainable and meaningful path for people. So, but at the end, I do want to ask you, you seem very optimistic about the fact that finance can return to becoming a society good. Why are you optimistic? And since the name of our show is Policy Punchline, what would be your punchline for this interview at the end?
Yeah, I mean, the reason I'm optimistic is, so I think there are a few reasons, but one of them is I do feel like this generation of younger folks has been marked very deeply by the global financial crisis. And I think will probably also be marked very deeply and influenced very deeply by COVID. And the impact of that, my guess is that it's going to foster greater interest in understanding one's role in society. When everything's going well, you can pursue your self-interest without focusing too much on your impact in society. But when the wheels come off and you see a lot of people suffering, there's, I think, greater recognition that you can't be on autopilot. and I see it amongst my students. I see it also amongst you know, the many students that took my classes and that I keep in touch with. And so I am optimistic because I think the younger generation approaches finance more often as a tool to address some of the economic and social problems that we're facing. But at a minimum, I believe that there's greater awareness of the downside of finance, and that very fact will make people more thoughtful. And with the book, all I'm trying to do is create greater awareness of these the indirect impact that people have, and try to show what a path might be to create value in society while working in a conflicted industry.
Well, Professor de Swaan, thank you so much. Wonderful punchline. Obviously, such a great conversation. Roopa, thank you so much for joining me today. It's just great for me to talk to both of you today. Thanks so much.
Great. Well, my pleasure. I very much enjoyed the conversation, and thank you for having me on and for having great questions that were difficult. and then think deeper about these issues.
Exactly. So, well, this concludes this episode of Policy Punchline. You should totally go check out Professor de Swaan's book, Seeking Virtue in Finance, Contributing to Society in a Conflicted Industry. It would make your thinking more nuanced. It will raise your awareness about some of those issues. It will not be a radical treatise to try to append your worldview on finance per se, but it will make you much more thoughtful in your path and beyond. So thanks so much for listening today. We'll see you next time.
Thank you.
You've been listening to Policy Punchline, a podcast generously supported by the Julius Rabinowitz Center for Public Policy and Finance at Princeton University. We would also like to encourage you to follow other podcasts produced by Princeton University, such as Politics and Polls by the Woodrow Wilson School of Public and International Affairs. Policy Punchline is intended to be informational only and does not reflect nor represent the views of Princeton University or the Julius Rabinowitz Center for Public Policy and Finance. For more information on subscription, donation, volunteering, or contact, please visit policypunchline.com. Thank you again for listening.